Today we're discussing Goldman Sachs Group, ticker GS. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. They have a market cap of $113 billion, enterprise value of $127 billion. So you see about $14 billion in net debt. Operating in the capital markets industry. So this is a financial institution, have financial services, corporations, financial institutions, governments, individuals worldwide, global banking and markets, asset and wealth management, and platform solutions segments. The global banking and markets provide financial advisory, strategic asset. So this is really asset management type businesses, but they also have, some global banking, these platforms. See if we can see a little bit more about platform. The platforms offers credit card, point of sale financing. So of course, Global Sachs is the company that has partnered with Apple to issue the Apple Card. So that would be something here. They would earn some kind of payment type, transaction based and costs. So some interesting things for deposit taking, payment solutions, various things like that. So this is the type of thing which would be a pretty good business. Anytime you're in asset wealth management and you can earn returns on other people's assets, that tends to be something that I'm pretty attracted in. It's, as an investor itself, it's something I certainly understand. So I immediately am thinking, hey, this is within my circle of competence, and that's something I like to see. So let's scroll down here and take a look at return on equity. First thing we can see here is they have 20 straight years of profitability. That's a very good sign. Not only were they profitable for 20 straight years, they were profitable through the financial crisis. You see they earned still a positive return in 2008, and then they bounced back to a 19% return on equity in 2009, 29% in 2007. Overall, pretty good numbers here. You see a lot of the time they're spending in the double-digit territory. Let's count those years. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So 13 years out of 20, they were above 10% return on equity, which is a really nice sign. They've been pretty stable since 2012, but they are bouncing around a little bit. So there is some volatility here in this underlying business, something to be aware of there. Overall, really good numbers here that would make me starting to think, hey, this is a relatively high quality business. Now, one thing we see here is they have a return on assets of 0.9%, return on equity of 10%. That tells you two things right off. You see that they have basically leveraged 11 to 1. If you multiply this return on assets by 11, you get a return on equity of about 10%. That's pretty normal for a financial institution. Nothing out of the range there. I tend to use just a baseline 10x leverage ratio for what I would expect many banks and financial institutions to hit. So that'd be 9% return on equity, but you can see they're getting a 10% number here. Pretty good numbers, and so that's pretty attractive as well. Likewise, they're trading at a price to book of 1. This is a great comparison of what would be a totally fair valued company based upon price to book. If you're trying to get a 10% return and you have a return on equity of 10%, then you want to buy the stock at a price to book of 1 or less. That is exactly what we have here, price to book of 1. Likewise, if you are able to buy a company at a PE of 10, that means your current earnings yield is 10%. So you can earn a 10% return without any growth. That's a very attractive setup to be in as well for you as a shareholder. Overall, the valuation looks very reasonable. I wouldn't necessarily need much of a cheaper valuation based upon the numbers here. This seems like a perfectly reasonable price for this company, and something I would certainly be attracted to on the price level for this valuation. Anytime a company is less than PE of 15, that's attractive, but specifically with the numbers we see here, you're seeing this is a reasonably priced company, could be cheap, especially when you consider that their 10-year CAGRs do show growth. You have a net interest income growth of 7% per year, earnings assets of 5% per year, and deposits growing at 18% a year. These are the driving forces of the future returns of this business, and you can see that they're growing quite well. And this is a company that is trading at a price that doesn't require growth in order to provide a 10% return to its shareholders, and yet they are growing, which means you have the possibility of substantially higher returns, starting to think maybe double digits. And so that's something that becomes very attractive when you combine a growing business, pretty reasonable returns on equity, and a good valuation. Everything you like to see here in this type of business. Now, of course, some of the stuff here is a little more complicated because it is a financial company, so you're going to see a little bit more volatility, but you can see that they're earning from net interest income. But one thing that's complicated that won't be able to be shown very well on QuickFS, unfortunately for this video, is they're going to earn stuff other than net interest income. I would bet highly that they have earnings outside of net interest income that they're also earning from their activities like wealth asset management, the banking services, the platform solutions. These are very diverse set of businesses, so they're not just earning net interest. But you like what you see here. They've doubled their net interest income over the course of a decade, 3.4 billion, 7.7 billion. So very good numbers here. That would be this 7% growth. Anytime you see 7.1% growth, it means you're going to double in a decade. Very good numbers. You can see their loans to deposits actually quite low, so they're not super leveraged in terms of the deposit base. That's a good sign. They're not having to take a lot of risk on that basis for their loans. And of course, this is the leverage I talked about. I was just ballparking about 11 as their average ratio, and you can see that pretty easy. Your 10-year median returns, you're about that 11 number, slightly higher in the current times, but pretty reasonable there. Now, you do see that their EPS has doubled over the decade as well. They went from $15 per share to $30 a share. That's a very good number. They also did that while paying out dividends each and every year, and the dividend is up 4.5x from what it was at the beginning of the decade. So you went from $2 a share to $9 a share. What's our current price? $9 a share. So you're talking about a 3% dividend yield today, which is a pretty good sign because you combine a 3% dividend yield with a 7% net interest income growth. Again, you're hitting that 10% return. Pretty reasonable. You're not making a lot of assumptions to get there. You're just talking about continuing the growth CAGRs of the previous time. But if they can in fact grow faster than that, which is suggested by something like their deposit growth, if they're able to monetize this deposit growth, that's a good sign. You're continuing to grow your dividend at really astronomical rates. I mean, look at some of these dividend growth years: 15%, 13%, 11%, 31%, 20, 30, 38%. A lot of excess capital is going out to shareholders. That's a very good sign. Likewise, you see again this earnings per share, $30. So they're at $11 PE on this $30 that they earned in 2022. But when you think about it, they have some years where they earned even more. Like in 2021, they earned $60 almost per share. That's 59, but let's call it 60 for a second. That means you're trading at 5.5 times your earnings on 2021. So now that is a one-off, this relatively high number. I don't know if it's sustainable based upon what we're seeing here, but you can clearly see this is a growing business. They're consistently making a lot of capital. They're paying it back to shareholders. Everything here is looking very, very interesting. So let's go to see the income statement to learn more. And if you're enjoying this video, if you're learning something, hit that like button. Don't forget to become a subscriber. But we're going to do a lot more in this video to kind of cover this business. So you can see interest income, interest expense. Again, this is showing it like financial institution. You're going to see these numbers range in that as well. One thing that's not really captured on the other side is that you've only doubled your net interest income. You've actually tripled your interest income. Now, your interest expense have gone up as well. But again, as these interest rates start to rise, that's something that might impact the business. Could be positive or negative depending upon they manage their balance sheet. You can also see their provision for credit losses is not super high. That's not gotten out of control in any sort of means. Now, what's really interesting though, and this is why it was really important to talk, hey, this is more than just, your average bank or financial institution. They have significant non-interest revenue. Their non-interest revenue exceeds their non-interest expense, which if this was a bank would be exceptional. I love banks that have this type of setup because it means that they're earning money more than just their interest income. And you can see their pre-tax income is substantially higher than that. So you see your net interest income after provisions was like $5 billion, but the overall pre-tax income was $13 billion. So, 30 to 50% of their income is coming from that interest, but a lot of it is becoming from their non-interest revenue being substantially higher than their non-interest expenses. And that sets up for a very good business model. They're not solely dependent upon interest rates in order to be effective. And what's really interesting is I really look down at this. Look at their shares outstanding. They've gone from 500 million shares outstanding down to 358 million shares outstanding over the course of a decade. So in a single decade, they've retired 30% of their shares outstanding. That's really impressive because that means that you're adding about 3% per year to your overall compounding rate. So you have a 3% buyback, you have a 3% dividend, which is what I was estimating here on this dividends per share. Those dividends are growing very quickly. Your shares outstanding are going down very well. This is great at capital allocation for you as a shareholder. I really like what I'm seeing here in terms of this business and how it's being managed. Now, balance sheet, again, any financial institution, these balance sheets are very complicated. You'd want to study both the FDIC type reports and then, of course, their 10K before you'd make any sort of purchase because they can be very complicated and aren't going to show up as well on this business. But you can see a lot of cash. You have $240 million in cash, $371 million in securities, $4 million in gross loans. You can see their gross loan book has grown significantly over the course of the last decade. That's a very big amount. It's also worth noting their PP&E numbers here. is $19 billion, but it's, basically infinitesimal over their total assets. 1 to 2% of their total assets is PP&E. For the most part, it's these other assets, it's these investments, net loans, everything like that. Now, with any financial institution, you're going to have stuff like deposits, you're going to have long-term debt, other liabilities. These things all have to balance out. It's not like these assets are all protected. You have a lot of leverage built in here. This is just how the business works. You get a significant amount of assets and a relatively low amount of equity against those assets. That's what balances out. So where does this 11 times come from? Well, you have shareholders' equity of $117 billion here, and yet you have $1.4 trillion in assets. That's what I'm talking about when you talk about this leverage. They're leveraged up 12, 13 times currently. That's where that leverage is coming from. That's sort of shareholders' equity that you see there as well. Let's see. Always good to see your retained earnings. One thing that's really interesting that kind of indicates this company is relatively cheap. So your retained earnings is higher than your shareholders' equity. Your retained earnings here is quite big, $139 billion, and I believe that is bigger than your market cap. So you can buy Goldman Sachs today for less than their historical earnings power. That's always a really nice thing to see. That's relatively rare that you can find that, but it's just something that just leaps out to you because you can see that with their current recent earnings, you're buying a business at book value, but really you're below historical earnings, which is always a nice way to see it. Now, it's kind of distorted a little bit with these numbers because you have paid in capital, you have the treasury stock. This treasury stock is, of course, the buyback numbers, but we're going to study those buybacks more with the cash flow statement. Looks like every single year, maybe not every year, but they have a lot of distortions on working capital that distorts some of this cash flow between the net income numbers. Depreciation is a relatively small amount here compared to the overall amount, so I'm not super concerned with that, and it seems in line with your kind of PP&E spending. A lot of money in investments. That's not really a major thing for me here. What I want to focus on here is this net issuance of common stock. You see this steady buybacks. Every year they're doing buybacks. 6 billion, 5 billion, 3.8, 6 billion, 6 billion, 3 billion, 5 billion, 2 billion. Lots of buybacks. And importantly, those buybacks substantially exceed their stock-based compensation. It looks like the only year in which it did not exceed your stock-based compensation was 2022. They were really close actually in 2020, but for the most part, they're buying back a substantial amount of stock every year. They're both offsetting their stock-based compensation, but also buying back even more than that. Now, they are growing their debt over time, not uncommon for a financial company. Again, it's just inherent to the leverage of the business. For a non-financial company, this would be a major concern. For a non-financial company, preferred stock might be a major concern, but that's simply not true. This is a lot more common to the business. You can also see cash paid for dividends. Even though they've grown their dividends a significant amount over the last decade, they're still only paying out $3.6 billion in dividends against, $11 billion in net income. So you're only at a 25% kind of like payout ratio on dividends. All that extra cash able to go into common stock, growing the business. It's a good sign. You like to see that. So capital allocation looks good. The balance sheet looks good. Income statement looks good. And the overall business quality looks good with the valuation. So this thing has everything that I look for, which means Goldman Sachs will go on my watch list. This looks like a really interesting company. 20 straight years of profitability, always a plus for high quality. The capital allocation, always a plus for high quality. They're growing, and you can get at a really nice price here. Price to book of 1, price to earnings of 10. It's relatively easy to see how you can earn double-digit returns by buying Goldman Sachs stock, so that always gets me excited as a potential investor. I hope you've enjoyed this video. Hit that like button. Don't forget to subscribe. You can ring the bell so you can get notified when I upload new videos. And if you like this software, quickfs.net, my affiliate link is the first link in the description below. I hope you'll check out through that link. It's a great way to support the channel. Thank you for listening. Until next time, stop paying fees, start building wealth.